about agency finance and funding. So basically, how do you get your finance right when you're talking to a bank? Certainly post-GFC, the world is very different. Capital is not as freely available as it once was, both debt and equity. And one of the things we've seen, especially in the last, say, 3 to 4 years, is businesses, including the real estate industry, they have great businesses, they can't always demonstrate the value of their business to their bankers. So what do we look for? It's pretty simple, those 3 things. That summarises what a bank is, that the banks look for. Character, cash flow, collateral. Character, who are we dealing with? What is the value of this person's capability as a business owner, the ability to manage relationships, turn that into revenue, and turn the revenue into profit, and the profit into cash. At the end of the day, that's what we're looking at. You guys live in a great industry. You have businesses that are very much top-line focused, and your ability to go and generate additional revenue is untold. It's only capped by your imagination. Turning that revenue though into cash at the end of the day, which is why we're in business. One of the many reasons why we're in business is a hard bit, and that comes out through, I guess, what we were really referring to as business acumen. What's the likelihood of this person being good for what they're asking from the bank? Cash flow. What's going to service the debt? What throws out of the business every month or every week? Too often businesses, I'll say, here, actually, look at my P&L. I made 200 grand this year, or 300 grand, or whatever the number is. And I say, great, where's the cash? And they look at their account and say, where's the cash? Well, it's locked up somewhere in the business. So that's part of our job, and part of your need to understand where does the cash go? Has it been used to fund debt or equity in the business? I won't get too deep on that today, but it's understanding where the cash goes in your business and understanding how to extract that, so then you can use that to buy rent rolls, buy property, holidays, school fees, whatever it is that you're in business for in the financial sector. Collateral's the last way out. So pre-GFC, we lived in a world where, as I said, there was lots of liquidity. The banks and lenders couldn't get the money out the door fast enough. And so a lot of lending practices were driven by what's the value of the asset that's being funded, rather than what's the cash flow that's coming off the asset that you're funding. That's the most important bit. So collateral, in a banking sense, it should be the last way out. That's the last. If things have gone completely pear-shaped, that's the last thing we look to do in terms of selling the asset. And it's 9.99 times recurring. That's not where you ever want to be. It's that one in the middle, and the one in the middle is driven by the one at the top. So as I said, understanding your business. I'm a big believer in looking at different industries to sort of look for comparative value. And a couple of years ago I had a thought comparing a fund management business to a real estate agent, particularly referring to your rent roll. And I looked at the way financial planners and fund managers get paid. They get paid a percentage of what they manage. So let's just say a typical rent roll, let's say you've got 400 properties. Let's say those 400 properties have a median value of, say, $400,000. We're talking about $160 million worth of funds under management, if you want to call it that. Now, I know there's distinct differences between the business. A fund manager, though, they'll get paid around about 1%. Now, we're going through some change in that industry at the moment, but they're around about 1% of the value of what they manage. Once in a while, 1% of 160 million is a pretty big number, 1.6 million bucks. Whereas if I manage 400 properties, I'm probably going to generate an income of around about $500,000, revenue of around about $500,000, including letting fees and sundries and all the other bits and pieces that you're able to charge. So then I said, well, why does one get paid a percentage of value and one gets paid a percentage of rent? What's a percentage of rent collected? Well, I guess that's an historical thing, but at least if you're able to translate the difference between the value you provide versus what you get paid, then I think you're more able to bridge the gap into, or not bridge the gap, because 400 and 1.6 is an enormous gap, but you're able to charge more for what you're worth. And I think that needs to extend to the people that you have managing those relationships. Because at the end of the day, your rent roll is only as strong as the relationships you have with your landlords or your investors. So how do you maintain and invest in those relationships with your landlords? Is it through your staff? And so then you say, well, yes, most of the time, most real estate businesses is through your staff. So then you say, well, what's my relationship like with my staff? If I've got ordinary relationships with my staff who manage my rent roll, manage, of 400 properties, let's say it's worth about $1 million, depending on what the multiplier is or marketplace is. You probably should, if you haven't got ticks in those boxes in terms of the depth and strength of the relationships with your staff that manage the relationships with your landlords, a really easy rent roll, then you probably want to do a bit of an audit on the business in terms of how do I raise the value of those relationships and improve the value of those relationships to make the assets sweat a bit harder. And that's what I'm referring to, maintaining the rent roll versus managing. The real estate industry, I will make a tax comment, is clearly very highly taxed. Stamp duties are taxed. Entry costs and exit costs, by and large, are pretty high. Property as an asset class, resi property as an asset class, is not particularly liquid, not like, say, a share, where you can sell it typically pretty quickly. So, I'd say, do you maintain your rent roll or do you manage the asset? So managing the asset is actively talking to your clients as investors and referring to them as investors and maximising yields, maximising capital growth, minimising expenses and outgoings, and hence investing in the relationships you have with landlords, which leads to a better revenue and a cash outcome. Or do you maintain it? So do you maintain the rent roll by getting the tenant right, collecting the rent, fixing small capital items, capital improvements on the property, or do you actually say, Mr. and Mrs. Investor, at the moment we're getting $300 a week rent for this property. If we spent $10,000 on the property on a new kitchen or tiling in the bathroom or some capital work somewhere, could we get an incremental return over and above the value of our investment? So can we take the rent from $300 a week to $350 or $400 by spending some money? Okay, so what I'm saying there is invest back in your rent roll in the sense of managing it as an asset that you've been entrusted to manage. So in terms of finance, so the previous slide was really talking about understanding where the value is in your business and what generates the cash. And obviously, I'm happy to have this debate at any time. The real value in a resi real estate business is in the rent roll. Arguably, there is value in sales goodwill. And I'd love to have a cup of coffee with anybody who wants to talk about that, because I've got views both ways.